So I'm here today to talk to you about remuneration, risk management and the current provisions to the UK Corporate Governance Code. Just to set a bit of background, this is the framework of the UK regulatory process, and just to sort of set context that we're in class fits in it. We're the UK's independent regulator responsible for promoting high quality corporate governance and reporting to foster investment. We develop and promote both the UK Corporate Governance Code and the Stewardship Codes. We set standards for accounting, auditing and actuarial practices, and also oversight and conduct of these professions, and our independent disciplinary procedures govern these people too. And we also maintain the issue UK GAAP, which we use for some SMEs. So, obviously, we've got the government and the European Union driving most of the legislation that are relevant to us, and then alongside our sister regulators, we've got the Financial Regulatory Authority and the Financial Conduct Authority. Within that, there's the UKLA, which gives the code, the UK Corporate Governance Code, its authority, and then it drives through to professional bodies, London Stock Exchange, and then there is the Financial Symposium. So if I talk about the UK Corporate Governance Code, this applies to all premium listed companies on the UK Stock Exchange on a comply and explain basis, which I'll come back to. It originated in 1992 with Capital Report, and iteration since then. It allows regulators to set standards and require reporting, but the shareholders are the enforcement of that. The rationale is that it's intended to raise best practice above legal requirements, and that the shareholders decide whether the board is acting in their interest. It has 5 sections, covering things from board leadership and composition, effectiveness of the board, reporting and the risk management processes, remuneration, and finally relations with shareholders. There is additional guidance that sits outside of the code. At the moment it covers the audit committees and risk management too. I will come on to where risk management fits into this because it's going to change. And in terms of comply and explain, that process is the idea that the code is there to be followed, but obviously if it's felt to be supporting a company that it wasn't in these particular circumstances, they are able to explain why they do not therefore comply with the code. However, there's high rates of compliance. As of last year, 57% of companies were fully compliant, and 37% with all but one of the code's provisions. It's a rapid uptake of good practice. That's the main reason why we're keen to see using high numbers of compliance. And we've got specific successes which date individually back to the original 1992 guidance, where the role of the chairman and the CEO were to be split, where we've got majority of independent directors on the board, and that the audit committee, its role and responsibilities are dictated by, set out by the code. And likewise, the board evaluation was another success. Most boards do carry out an annual evaluation according to the code in 2010. It should be externally evaluated once every 3 years. And that currently is at the 350 level. I'll take you on to the UK Stewardship Code just to give you an idea of the Corporate Governance Code baby sister. This only dates from July 2010. And its aim is to enhance the quality of engagement between asset managers and companies to help improve long-term risk-adjusted returns to shareholders. Its last update was 2012, when also the UK Corporate Governance Code was looked at. However, the decision has been taken not to make any amendments this year, and instead to focus far more on the implementation by asset owners and embedding this, so that there's greater involvement of the code with those. It describes the steps asset owners should take to protect and enhance the value that it accrues to the ultimate beneficiary. And it sets out a number of areas of good practice. These are the 7 that are set out here. But these are that we believe the institutional investor should aspire to, and again, it operates on a comply and explain basis. It does, however, though, require, or asset managers, however, are required by the Financial Conduct Authority to set out whether they report against this in their code. However, today we're talking about the current consultation on the provisions to the Corporate Governance Code. I'm pleased to know there's 1 week left. You've still got time to respond. And please do. We very much welcome anybody who'd like to tell us that got it right. That would be very helpful. The changes that are in the code consultation currently build upon 2 pre-consultations we carried out at the end of last year. So we looked at remuneration on behalf of the Department of Business Innovation and Skills, or BIS for short, and also we looked at risk management and going concern as a sort of precursor to the work we're looking at now. The subject of the consultation or the outcome will be changes that we made will apply from the 1st of October 2014 accounting reference dates, and we look to publish the final set of wording in September. In detail though, the 2 main pieces we're looking at are remuneration or risk management and going concern. So the main changes I want to take you through are for remuneration, that companies should ensure that remuneration policies are designed for long-term success of the company. This is a replacement of Principle D10, basically trying to make sure that the company's design remuneration policies promote the long-term success and not just the short-term benefit of the directors. We're also emphasising the lead responsibility for doing so with the remuneration committee themselves. The second one talks about putting arrangements in place that will to enable the recovery and withholding of pay. This is a requirement that companies should establish these arrangements so that in certain circumstances where it would be appropriate to do so, this is noted. However, we are not setting out details on how these points will be played out, so there's flexibility for companies to interpret it based on what their requirements are. Third one, this considers how appropriate whether vesting and holding periods for deferred remuneration are correct for the company, and we're trying to suggest that companies take a greater appreciation of what happens when a director leaves the company. And there's a Schedule A to the code that covers the design of executive remuneration schemes, and there's detail within this about highlighting that we want companies to pay more attention to these sort of factors and how long a share should be held up for vesting. And finally, and this is a little bit particularly, is that we'd like companies to explain how they're going to engage with shareholders where there's been a significant vote against a resolution. Now, originally, we were asked by BIS to request that this be for remuneration resolutions only. However, we felt that to single out remuneration was incorrect. It gave it more weight than any other resolution that was put forward at a general meeting. So the requirement now will be that if there's been a significant vote against, and we've asked that the company itself sets what that percentage is. There's a guidance that exists that GC100 and Investor Group put together that suggests 20%, but we're quite well aware that for some companies it can be higher or lower, so we're asking companies to define it. And when they announce their AGM results, we want them to sort of highlight where they know they've had significant pushback against a particular resolution, what they intend to do. In fact, someone said to me the other day, won't this create boilerplate language? Because it's a very short turnaround. To some extent, we are well aware that this may be the case. However, for many companies, they do get a heads up that they're going to get a significant number against. So we want them to think about how they would work with their shareholders to understand their concerns and take that forward. The new legislation that affects remuneration that came in last year does ask that companies in their following year's annual report take time to explain what they've done about votes against. However, this is a line that's handled quite quickly, so that shareholders are aware that a company is taking its concerns seriously. That's what we're looking at. In terms of risk management and going concern, this has been a more difficult area to assess and to come up with some final wording. So we've asked that companies should state if they're adopting a going concern basis of accounting. This has been narrowed down and heavily defined in the new version of code to make sure it's clear that we are ultimately accounting reference. And as well as making this statement, companies have to identify any material uncertainties to their ability to continue to do business, continue to report against this. We've increased the idea that there's a robust assessment of principal risks. This effectively is codified existing best practice, but there's an explanation of how these risks are managed and mitigated, which we're also looking for information on. We have heard some companies suggest that the difficulty they've got if they're US listed is to state the manage and mitigated piece. For some reason that seems to cause regulated issues. However, there are ways around this. So we find that they can, or confident they can manage to fit within our code requirements. The newest piece is this viability statement, so stating that if they continue in operation, or that they will be able to continue in operation and to meet their liabilities, but we've asked them to specify the period they're covering and to provide a rationale. There was a lot of suggestion that we state a year, 2 years, 3 years, 5 years, a period of time in which investors can take comfort. Quite clearly, a business that's in retail, clothing versus a mining company aren't going to be operating on the same scale in terms of future risks. So we're asking people to take a judgment about what their future strategy looks like, what they know is coming on their horizon, and to specify in their report what they're stating about it. So it could be a 5-year period, and we want them to sort of provide their rationale for saying that. Final piece, though, is monitoring risk management systems and internal controls. This is an important responsibility of the board, and the minimum we're looking for is an annual effectiveness review, and the report should be disclosed in the annual report on how well it's been done. We're looking to make sure that the stakeholders of various types, both ourselves as shareholders and other parties involved, can take comfort that the business has managed its risks appropriately. Oh, I should just point out the guidance that I mentioned earlier, we will be revising. So we have a risk management piece at the moment, which title is Turnbull, but it also sits alongside a different part of the FRC's guidance relating to going concern. When we published our consultation at the end of November on this particular subject, we put together the guidance in one new package. We've had comments on that, and we're now working through a revised set of changes for that. The current consultation on the code includes 2 sections from this guidance, just to help give a wider piece of flavour to the code changes. So when we publish in September, the full UK governance code, alongside it will sit this new revised risk management guidance piece. One other part of our current consultation is to look at a heads-up question for people to consider in terms of corporate governance disclosures and where best they can sit. In this modern world, we've all got digital devices, we all use the internet. There's a lot of people that are groaning under the strain of a 200-plus page annual report. And the thought was that if we could think of better ways of managing governance disclosures, then maybe we have some way of putting out cushion clutter, which is not a phrase that people like to use. So we're basically seeking views on whether there are benefits to publishing some or all of the information currently contained in the corporate governance report. So it could be on a website rather than the annual report. At the moment, we are not sure how well this would actually work in reality, so this is the start of the 10th question to see if people have got many bright ideas. We're also asking, though, if there's any disclosure requirements in the code that could be dropped entirely. I've yet to see any responses so far. We've only had about 5 or 6 who approach this subject, but we get lots of nods when we talk to people about wouldn't it be a good idea to cut as much as possible out of the annual report. There are, unfortunately, though, issues with doing this, so the results of the consultation will actually go ahead in 2016. So if we feel that there's enough there, we'll work on it in the next few years, because this is where it gets very complex. There'll probably be Companies Act changes, so we need to involve theirs. There'll be an effect on the UKLA's rules, so we'll need to talk to the Financial Conduct Authority. It may well be that we need to get institutional investors as the users of the annual report, and auditors as those who will audit the annual reports around the table to try and discuss what each party may or may not feel about any reduction or change of location. We have heard, for example, that investors like a time-bound document they can hold and know that this is what the company said at this particular point. Equally, we've heard auditors comment on about how can they possibly audit, say, a corporate governance statement that's on a website that's live. When are they going to freeze it at a point that then they can make a judgment on? So there are many issues to work through, and that will be next year's exciting. I thought I would cover some other issues that are going on at the moment. So within the corporate governance consultation currently, some people may be aware that the Competition Commission did a lot of work on audit committees. audit tendering. And when we revised the code in 2012, we added in a new provision that suggested that companies should consider putting out for tender once every 10 years their audit contract. The European Union has also been looking at the audit market as well as the Competition Commission. So finally, the Competition Commission realised that the European Audit Directive was going to have an impact on the UK. So their results have been frozen, and we aren't taking forward some of their recommendations they've made to the UK, to the FRC specifically, or orders that would be actually legally binding on the companies. And they've actually decided they're going to wait to see how the European Audit Directive, what effect that has on what that is, or working on the implementation of that now. And we will then revise the code in 2016 rather than try and change it now on the basis of not being sure where everyone's going and then change it again in 2016. We felt that people really wanted to be left to manage things as they are for now rather than having to keep changing them. This section about board composition, we have a new project which I'm leading on succession planning and nomination committees, and this was driven primarily from two factors. But two factors. One is the Parliamentary Standards on Parliamentary Committee on Banking Standards, which found that some of the big companies that got taken over, like RBS and Royal Bank, Royal Bank is RBS, or HBOS, that the boards had a number of directors who were possibly yes men, and they were concerned that perhaps the board's non-exec directors weren't being as independent and as challenging as possible, and there were concerns that perhaps natural challenges, as the phrase they used, were being sifted prior to a shortlist being presented to the board for director appointments. Secondary, we've also looked at board evaluations and spoken to a number of the board evaluators, company secretaries, the chairman, just to understand how well that piece of work was working in the marketplace. And pretty much the first thing, or the main thing that came out of any evaluation on the board was that their succession planning needed looked at and they needed to give it more emphasis. So we decided to take these points and actually make them into a project where we're looking for understanding what good practice looks like in this, so the usual things under a bus, up to we're actually thinking about this strategically, this is the direction the company's moving in, what's the board requirements, what do directors' skill sets needed, and where have we got gaps. But we're also keen, and again, to stress, this is not necessarily meaning there'll be a code change, but of the three subcommittees of the board, the nominations committee is the one we've not really looked at, and it's a core sibling of the other two. So I think we want to understand what the processes currently are from a good practice, if you like, within the nomination committee world, and understand where perhaps they should maybe take more responsibility to look at succession planning of both executives and non-executive directors. But this project is at the moment in the scoping phase, and it's very, very big for us because it does also touch on diversity issues, which obviously could mean gender, but hopefully we're looking at it in the wider sense because I think that's more relevant. But there's also a limit to both the time and the resource from the FRC. We are a team of just 3 of us, plus a team PA, and also from what the FRC itself can do. We have a small remit on this particular field, but it might be that we can flag up to the other regulators or even to the government. There are issues that can be taken forward by them. Things like the executive pipeline, which is a sort of phrase that's being touted around at the moment, the idea that we should be looking to recruit internally, bring women up, particularly one of the ones. But that's a big change from a sort of societal or government made thing. That's not an FRC changing the code piece of work. And the final area we're looking for is the impact of the recent elections in Europe and what this will bring in terms of future legislation. We still don't quite know how that will pan out in terms of where the new parliamentarians will sit in terms of committees that we work with. There seems to be quite a few horse trading going on about who's going to be in charge of what. Once that's settled down, we'll better feel about who we're trying to work with and what we need to do. But we know, for example, that the Shareholder Rights Directive, which will be a big piece of work for my colleague Hannah, who looks after the Stewardship Code, because that will have an effect both on the UK investment market but the Stewardship Code itself. So those are the sort of key points that we're looking at the moment. I realise I've rattled you this, sorry. But what I was going to say was, the code itself, as I've explained, is on the basis of what I explained. It's meant to provide companies with a basis from which they can move forward in terms of understanding what governance looks like. We don't like to say it's rules because it doesn't have the same basis of rules. It's not covered by people like the PRA or the FCA, but it's there for companies to make use of and to understand what best practice might look like. We're attempting to foster better engagement between shareholders through the Stewardship Code. These are both ways and means we feel that are useful to ensure that the UK continues to operate on best practice itself as a country in terms of its own. I suppose my contact details are towards the Commissioner, and I was just going to say I'm here for the rest of the day, and I know there's a panel session later, so if you do have questions either directly for me on the code consultation or even the succession planning project, which if anyone is very interested in that, then I'd be delighted to speak to you. We're looking for help and understanding how to best to research some of these things, so as academics, and you might be able to give us some more clues. I do apologise, I'm running massively early. Thank you very much.